Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. International equities have been leading the charge. Even with the ongoing war in Ukraine, tariff concerns, and uncertain global growth prospects, our next guest says that it's a reminder that markets don't always behave the way we expect. So if you are only focused on, for instance, the US market, remember that you're missing out on up to 70% of the world of stocks. Might this moment, be a catalyst for change? Joining us from Boston today to discuss what's unfolding across Europe, Japan, and beyond is portfolio manager of Fidelity International Growth Fund, Jed Weiss. Welcome, Jed. Great to see you again. How are you?
Great to see you, Pamela. Thanks so much for having me. I appreciate it.
Oh, we're delighted to have you back, and what a moment for it. Certainly been thinking about the way you approach things, but let's talk about this moment. I mean, a lot's going on that's wrong in the world in terms of what's bad for markets. And yet, over to you.
Yes, no, I think you nailed it in your intro. If you laid out a set of facts, a year or two ago, there's going to be the threat, the reality, but also the threat of tariffs. There's a war in Russia and Ukraine at Europe's doorstep. There's a global economic slowdown, U.S. market underperforming. One wouldn't naturally say, "Oh, this is an environment in which international stocks will thrive." And yet here we are. I think it's a reminder that catalysts are just very hard to predict. But the starting point, if you just step back and think about the value of having a portion of your fund in international, I think is still valid, which is it's as you highlight, a huge percentage of the world's stocks are international securities. So in some ways, only investing in the U.S. is sort of fighting behind with one hand behind your back, or investing in an S&P fund that only invests east of Mississippi or something like that. But also international stocks relative to their own histories and versus their U.S. counterparts are historically quite cheap, even with the recent run that we've seen. Almost no matter how you look at it, on a PE, EBITDA, dividend yield, free cash flow yield, whatever the metric, the message is generally the same, which is international stocks do look historically attractive. And, historically, I've gotten the question, well, Jed, what's the catalyst for change? And I generally don't have an answer to that question, because if there was a clear catalyst, it would already be reflected in valuations. I didn't necessarily expect that the U.S. would be able to unify Europe in a way that Europeans themselves have not necessarily been able to unify in recent years. But here we are.
But here we are, fascinating. And you're right in the middle of it. The name of the fund says growth. So part of your process certainly is going into those areas where the stocks are growth stocks. But that said, remind us, and for those that have not met you before, bring us up to date on how you approach your investing, how you go at it.
No, 100%. So, as you mentioned, I run sort of the International Growth Fund. So it's a large cap oriented international growth fund. My sweet spot for investment: multi-year structural growth stories, high barriers to entry businesses at attractive valuations based on my earnings forecast. So, this is not a growth at any price fund. Valuation is a very important part of the process, but it is valuation based on my earnings forecast, which may be different than the street. And I tend to run a low turnover portfolio, 20 to 30% over time. Why? Because I am looking for these multi-year structural growth stories, high barriers to entry businesses, and those don't tend to change that often. When I think about high barriers to entry, I'm thinking about a sustainable competitive moat. And one metric I use, though not the only one, is pricing power in real terms at every point in the cycle. So right now we're talking about inflation. These are companies that can maintain or raise price, in real terms, so over and above inflation. But even a better metric is often when there's a big downturn, either a sector-specific downturn or a macro financial crisis. And these are companies that can maintain or raise price even in very difficult economic environments. And the reason that's important is, while they may keep their price, they will be slashing their cost structure if demand's down 20, 30, 40%. And so they'll benefit from higher cycle to cycle margins and returns. And yet probably in the short term, their stock will have been sold off because of near-term worries. The only thing I'll add is portfolio construction, which is a very important part of my process as well. It's important to me that underlying stock picking is the key driver for the fund's performance and not macro exposures. And that's an easy statement to make, but a hard one to make happen. And so I end up not only working with our quant team, but also building a lot of proprietary spreadsheets myself, or single spreadsheets with lots of tabs, basically slicing and dicing the funds in lots of different ways to make sure that I understand the underlying exposure to the fund. Not that I want to be neutral everything, but I want to have careful boundaries so that I never have to go in front of you or anyone and say, hey, gee whiz, I'm sorry the fund underperformed. I was sure oil was going to 100 and went to 50, or, the dollar was going down, it went up. Again, won't be neutral everything, but I want to have careful control over those exposures so that I can let the underlying stock picking shine through.
That's so interesting. We might go into the exposures vis-a-vis tariffs in a few minutes, but I
Sure.
also just wanted to ask you, over the years we've spoken to you, and you really do take a global approach. I mean, you have been in sort of the four corners of the globe looking for ideas. Just tell us a little bit about the universe. I'm assuming if these are bigger cap stories, you're not. Are you going into EM, or to what extent are you going to EM? Tell us the
Fair
universe.
enough. So the benchmark for the fund is EFA growth. So that's a developed market benchmark. So Japan, US. I'm sorry, Japan, Europe, Australia. Like these are big markets in the benchmark. The fund does have the capacity to own EM securities, and even in some cases, some U.S. securities that may have majority international exposure. But the bulk of the fund is developed international. I will say I spent 3.5 years working on our emerging markets fund, call it 20 years ago. So that's certainly an area that I feel comfortable, and I do travel to emerging markets. So you will find some EM securities in the fund, but it tends to be a smaller piece of the total portfolio. I can kind of be opportunistic, which I appreciate because anyway, having the EM benchmark can be a challenging. Some of the big heavyweights are not always stocks that I'm excited about, so it's helpful to be able to be opportunistic in that realm.
Yeah, fantastic. Great approach. And it's good to sort of hear again how that works. Okay, so let's talk about Europe, because Europe
Sure.
3-4 months ago was a pretty different story to what it is. I mean, it's been gangbusters, and it's been a fiscal story for governments adjusting to a new world order to an extent that has been sort of the geopolitical story. What has it done to stock markets? Because some of them have been on fire.
Yeah, fair enough. So there's been a couple big changes. One is with regards to European defense. Defense spending was already rising in Europe, especially given the Ukraine war. But I think things have really taken. I guess the recent commentary and actions by the U.S. government have really been a wake-up call for a lot of European governments, and so we're seeing big change when it comes to the desire to spend as a portion of GDP, and the desire to spend specifically on European defense companies. And so we've seen big reactions when it comes to European defense stocks. Now, one has to be careful. I need to be transparent. Although I have some exposure in that realm, the stocks have come up so fast, so quickly, and the valuations have gotten rather expensive. I haven't necessarily been adding exposure, and in fact, in some cases, I've been taking down my exposure modestly. But certainly, that is an area where there's been a sea change. I guess another example of a sea change is the news in Germany, where they will start excluding defense and infrastructure spending from some of the budget caps that have historically constrained fiscal spending, and that's a big deal for
That's
a country
massive, right?
that
Yeah.
has been very strict for a very long period of time. The trick there is making sure that you can find stocks that are relevant to that theme, where there's a dislocation between the valuation and the enthusiasm. And again, one has to be careful, because a lot of big German companies are actually exporters to markets that may not necessarily benefit from what we're talking about, and could even be hampered by some of the tariff issues that you highlight. But on the other hand, there's companies in European cement or some construction, et cetera, which may be real beneficiaries here. So that's another interesting theme. I will say one area we talked about last time we spoke, I think back in December, which remains interesting to me, but less intuitive given the recent news flow, is the UK. It is not that I am particularly excited about UK domestic economy. Like, it's kind of a stagflation, slow growth, a little bit higher inflation than you'd like. However, I will note that post-Brexit 6-7 years ago, we've seen massive derating in the UK stock market, and there's a lot of great global franchises that historically traded at very high multiples that have now derated to an extent they're suddenly looking very attractive. And so I've been running the growth fund for almost 18 years now, and it's the last 6-9 months is the first time in my tenure that I've been overweight the UK. Which is, again, not necessarily a function of the fact that I'm a wild bull on the UK domestic consumer, but I think more a function of the fact that you have these great franchises that have derated significantly, and where I'm seeing opportunity. Getting back to the starting point of the conversation, which is European stocks look cheap relative to their global counterparts, and I'm trying to find these kind of market inefficiencies.
And you're right. You're right in the middle of that. Can we just go back to Germany for a second? Because I'm
Sure.
curious with those budget caps. This is sort of the fiscal story. With more money available to put towards defense and infrastructure, are those going to German companies, or are you looking at other European companies?
Fair enough. So in defense, specifically, there is a desire to spend as much of the incremental defense spending, but not just by Germany, but by France and other continental European companies on continental European defense companies. Now, there can be a gap between desire and reality. The reality is there's some technologies that just aren't currently available. And so, not all of that spending will go towards European companies. I suspect some of it will be going to the US, and some of it will be going to the UK, and some of it will be going to Korea, and some will be going to Japan. So there's other countries that will be involved. But the desire is that the bulk of that spend be spent on continental European defense, and I think that's why you've seen such excitement with a number of these companies. And the key is figuring out which ones have the product portfolio that can really benefit, that are well positioned to benefit, and which ones are not. Because the first reaction of the market has been to boost all these stocks, which is understandable. But I think over time there will be more differentiation between big beneficiaries and folks who will be benefiting more marginally.
Let's stick with Europe just for a second to sort of overlay the tariff discussion exposure to it. I mean, we just heard matter of sort of 24 or 36 hours ago that the auto tariffs in the US will be put on all kinds of cars coming from everywhere. Canada is focusing on Canada, but they're all nations that that are making cars and manufacturing them outside of the US. Germany is one of them. How do you stay away from that? Well, I guess you just stay away from that. Is that how you stay away from
No,
it?
no, it's tricky, and there's a lot of debate as to what degree these are tariffs that will be permanent, to what degree these are negotiating tactics for broader trade agreements, to what degree these tariffs will last in a new administration. Like, there's a lot of uncertainty, which is why when I talk to companies, a common theme I get is, Jed, if you tell us the rules, we will adjust our business to accommodate those rules. The challenge is the uncertainty of, will this tariff stand? How big will the tariff be? Will it, might it change in 2 weeks? It's hard for us, meaning the companies I'm speaking to make significant capital investments and build new factories or rearrange our supply chain until we know the rules. I will say I don't particularly have magic insight as to what the end result will be on some of these tariffs. I do think there's wide-ranging application. I mean, you mentioned autos. Of course, if you're already manufacturing, a lot of these foreign suppliers, in many cases, do the bulk of the manufacturing within the U.S. already. But it's also the case that there's very integrated auto supply chains within Mexico, Canada, the U.S., et cetera. And there's plenty of imports coming in the U.S. too. So these are big deals. I don't have a lot of exposure to the auto industry in my fund. It is an area I of course pay attention to. There's broad implications, and there's side implications for what happens to Canadian rails, for example. But
Right.
there's other businesses that are affected. But I will say my general approach towards this, or any area of extreme market uncertainty where everyone's focused on one topic, but where I may not have special differentiated insight on that topic, is to look for companies that are on the periphery where actually the resolution doesn't really matter. Is it 25% tariff or 10% tariff or 0% tariff or 50% tariff? Like, actually, there are some businesses maybe the stock is selling off aggressively, but the answer to that question is not that material to the business. Those are the types of opportunities that I'm actively looking for as we're speaking.
Fantastic. Let's switch to we spoke a couple of days ago and you had just returned back, I think, from Japan, where you've invested over the years. Tell us a little bit about the opportunity. Japan is, uh, apart from the auto tariff story, has sort of been exempt from the tariff conversation. And it's been an extraordinary market sort of maturing. Tell us what you think and find in Japan right now.
Sure, and exempt so far. Like, time will
Yeah, right.
we'll see what happens next week. I have no idea there. But what I can say is Japan is land of market inefficiency in my mind, especially as you get into sort of more mid cap oriented Japan. Some large cap securities, but even more so in the mid cap. There's a very long tail of securities, and falling. Remember, Japan had a huge boom in the 80s, and then a 25-year bear market starting in 1990, and that led to a dramatic shrinkage of the number of people focused on that market. And as a result, there's a lot of market inefficiency, which is different from saying just go out and buy the Japanese market. But it means my job as an active stock picker is a little more fun in Japan than some markets. And I think so. That's the starting point. Is some very cheap valuations. Companies where objectively, if you kind of just delisted them and relisted them somewhere else, they'd probably trade at a very different multiple because they're very cheap. They great free cash flow generation. These are very attractive structural businesses. They fit all my criteria, but for whatever reason, they're less on the radar in Japan. But there's also something interesting happening the last few years in Japan, which is changes in corporate governance. And there's a couple of interesting meetings I had to just reinforce that message. One was with a leading activist investor in Japan, one who's had, they've had some failures too, but they've had some notable successes, things that I don't think would have possibly been, could have happened 10 years ago. And it was a fascinating conversation. The head of the group highlighted that, the government seemed to be behind the scenes, behind their efforts. Like they would sanity check things before going forward, and the government, is sort of in general in favor of their efforts.
But that's so interesting. Like even an activist investor in Japan is kind of interesting. I mean, is that
fair enough? Well, look, it's been rare. If you look at the chart, and actually I just saw another chart on this morning, the number of activist events in calendar 24 was up 50% versus 23. And the chart is sort of low. And in the last few years, it's a hockey stick. Because I think finally, you're seeing the government that's supportive of some of these efforts. Not all, but some of these efforts. The court system, historically, if you sue a company for documents to try and, underscore malfeasance or what have you, the courts have sometimes given you the Heisman or not been as cooperative as they could be. And that is changing. And also the companies themselves, this was another point raised, which is, often these activists start with private meetings with the companies, and the companies are more likely to sort of fold earlier on, like say, yes, okay, we'll do it. And we'll start, spending our excess cash balance or cut down on our related party transactions or whatever the case may be. And the other interesting meeting I had was with a chemical company, kind of mid-cap chemical company I've met with for more than 15 years now. And historically, whenever I've asked the question, hey, your cash balance is well over half your market cap and you don't lose money even in downturns, like, do you really need that much cash? The answer has been, yes, we do. We're not going to do anything about it. And that's just how it is. We got to be prepared.
We save. We're savers. We save.
That's right. And a year or two ago, 18 months ago, they announced a 10% share repurchase, like out of the blue, just, hey, we're going to buy back 10% of our stock. And so this time I met them and I said, well, what changed? Why, we've been meeting for years. Why suddenly are you buying back 10% of your stock? And the answer was interesting. It was, well, we got a letter from the government asking us why we traded at such a discount to our price to book and what we were going to do about it. And that led that we said, okay, we better do something. So we're buying back a lot of stock. It's like, okay, and I've had meetings like that a number of times over the years, but that one really stuck with me on this most recent trip.
You mentioned that it was a mid-cap company, and I'm just curious because a lot of the Japanese large cap companies are kind of household names. Where within there do you play? Where are you finding opportunities in terms of cap size?
I find them up and down the cap spectrum. With this product, I'm not going to go in very small cap Japan, like that would not be consistent with mandate. But I am there. If I am seeing opportunities that are in more that mid to large cap range, and there are that actually within Japan specifically has been more where I've found the best opportunities. But there are also, I will say, I walked out of this trip excited about some large cap names too. So there were. And Japan is a market year to date that has maybe outperformed the U.S., but has certainly underperformed Europe. And so, if anything, I think from an incremental capital standpoint, I think it's a place where I'm that much more interested.
That's so interesting. And so, I mean, I don't know if you call that a rotation within or not, but I remember, I think you mentioned it was back in December we spoke, and you were really enjoying sort of the fundamentals of a number of Indian stocks, but they were expensive. They're really expensive. And then you kind of mentioned like UK was a little bit not quite left for dead, but lower valuations, big time. So just tell us a little bit about India. Do you still feel that it's overpriced? Really interesting fundamentals. What's your take?
So your memory is spot on. I had a very memorable trip that included India and the UK and some other places too. But yes, my takeaway was the macro fundamentals may not be so good in the UK, but the stock opportunities look great. And on the other hand, In India, the macro fundamentals look very good. The infrastructure improvements look great. The tax reform looks great, but the stock prices are outrageous. I will say the Indian market has significantly underperformed in the last 6 months or so. So it is a market where, of course, when you start from a very expensive level, you can underperform and still be expensive, and that is the case. But some of the extremes that I witnessed maybe a year ago this time are much less pronounced today, and so it is a market I'm taking a fresh look at because stocks have come down. I'm not yet willing to say they're cheap, but it is certainly less extreme than maybe we would have spoken about last year.
Okay, so interesting. Yeah, one to
Yeah.
watch when we catch up with you again. Maybe we'll. So, do you think, Jed, that tariffs may benefit India considering growing uncertainty in China? Interesting.
Um, I don't know. It's hard to say. Like, there's so much tariff uncertainty. It's a little bit hard to say who will be affected and who won't. And like even China right now, there's discussion of a Trump-Xi summit and what will come out of that. Will some things be horse traded? Okay, we'll do bite dance here and we'll allow Panamanian port sale here, but in return we want lower tariffs. Like I that also falls under the rubric of I'm not sure. I do think some of it comes down to starting point valuations. I think I mentioned in this forum because it was sort of late, second half of last year where I began expanding my exposure to some Chinese securities, actually, specifically Chinese tech. Why? Because the valuations have gotten very cheap, and actually some of the themes that people are very excited about. What are examples of businesses that will really benefit from AI? Some of the clear examples seem to be in China, and yet they were not valued as such at all. Now there are geopolitical risks, there's government interference risks, so one has to tread carefully. And as a result, my position sizes I'm keeping track of. But in contrast to what the opportunities that I was finding last year in India, which I'd been reducing my positions, actually at the end of last year, I started increasing my exposure to China. Again, not to overstate it, these are still relatively small numbers, but that's where I found the relative opportunity. So I think time will tell specifically with regards to tariffs. But if you look what I do, what I'm doing, not just what I'm saying, empirically toward last year, I was adding a little China towards the end of the year, and I'd been reducing India.
So you mentioned in there one of the most interesting pieces of the markets, I think, globally right now, and that is the AI everywhere else story. And
Sure.
you sort of alluded to it there. Just take us a bit further because this is obviously a theme that's going to get incorporated into most companies. How do you take a stab at investing in that everywhere else?
Totally, and I do think certainly if we spoke a year ago, I bet we did.
Yeah,
I've been making the point that international AI doesn't always get the same respect from a valuation perspective as their U.S. counterparts, and I still think that's true. Although some of those infrastructure stock, especially when it comes to hardware and power, a lot of those stocks ran a lot last year, and so empirically, what I've been doing is shifting my focus and attention less towards infrastructure. So the AI infrastructure build out, where I think there is a lot of it's legitimate, but there's also a lot of market enthusiasm, a little bit more towards AI consumption. Companies who can benefit from low cost AI to actually not only improve their costs, but in some cases, improve their products and services. These are often data providers. These are companies that control distribution. And that's where I'm finding the relative opportunity. But it's still, I think the core point is the same, which is for whatever reason, international tech and international AI specifically does not always get the same valuation respect as its U.S. counterparts. And I think therein lies an inefficiency.
That's so interesting. And where else is it? So China and deep the DeepSeek one was sort of the top of mind, and I think cracked open everyone's mind to looking elsewhere if they hadn't already. But what about in Europe? What about in other
So
places?
totally. And first, just the point on DeepSeek. I mean, not only I think DeepSeek told us a few things. One, pure model training companies may need to revise their business models because it's sort of commoditizing models at a faster rate than we were previously able to do. But it also told the story of, hey, some of these Chinese big media companies, the Facebook equivalents in China The same way Facebook has been benefiting from AI to improve ad targeting, et cetera. Like some Chinese businesses can do this too, and they can do so cheaply with companies like DeepSeek. But you're right, China is far from the only opportunity. There's lots of European and Japanese companies doing the same. Again, no commentary on future stock performance, but just empirically, if you look at the company that owns LexisNexis in the UK, they have been able
That's an old name, Jed, LexisNexis. That's an old
right.
name.
Fair enough. No, you're absolutely right. I remember in high school, I had a high school internship with a law firm, and we were using it then. But that's part of the beauty is there's so much case law data that they've accumulated over 50, 75 years that they're able to leverage AI to massively save time. So the same task that you might give a paralegal 5 years ago on, hey, go research the case history behind an upcoming case, AI can do for you extremely quickly. And of course, law firms are happy to pay for that. Saving gobs and gobs of time for their legal staff is very valuable to them. And you're seeing a real revenue uplift and a real revenue acceleration from that company. So there's a lot of examples like this where companies are leveraging AI to really improve their business.
This is such an interesting moment. And just to kind of see where it goes next, I might just ask you one more question on China in terms, we'll fold in the tariffs, but it has more to do with sort of how China is doing right now. It still has an overhang on its economy. There's still other pieces to the story there. How do you view China right now in terms of risk?
So it's a fair point, and I think the underlying economy is still suffering from this real estate overhang. There is still, a sizable real estate overhang in China. That's leading to pressure on the financial system. That's leading to pressure on the consumer. So, arguably things have stabilized somewhat, but it's a little hard to tell. The opportunities that I've been finding have been less about Chinese domestic consumption or Chinese real estate or Chinese financials. It's been more about these tech and media platforms that have the capacity to leverage AI to dramatically improve their business, yet trade at a remarkable discount to their global peers. That's where I've personally found more opportunity. But China's a big market. There's a lot of companies. So, it's always worth turning over stones. But sort of like my conversation about the UK and a number of markets, one shouldn't confuse my enthusiasm for some specific stock opportunities within a geography with enthusiasm about necessarily the domestic economy. That's a different statement.
So as sort of a final point, what would you like investors to know that you're watching, that this moment is about for you in terms of managing this fund?
Yeah, I think a couple things. One is you need to remember I'm going to stick to my knitting. Multi-year structural growth stories, high barriers to entry, attractive valuations. Stock picking driving the fund's performance, and an important reminder that there's always something to worry about in international, but that's part of the opportunity, and the key is to capitalize on scary headlines, capitalize on market dislocations to find opportunities. And that's what I'm doing. And there can often be a disconnect between enthusiasm for enthusiasm for a domestic economy versus the stock opportunities. And ultimately, my ability to bring value is to identify stock opportunities, and that's where I'm focused. And that will be true irrespective of market environment, irrespective of scary headlines. And actually, the more uncertainty there is, in some ways, the more fun my job gets, as my wife will attest. More of a spring in my step when I head off to the office.
Okay, so interesting to know that you are watching all of those for all of your investors. Jed, great to see you, and thank you very much. Have a good weekend ahead.
Terrific. Thanks so much. Enjoyed the discussion. I appreciate it.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.